Hello, everyone. Welcome to the webinar. So give us a bit of time while attendees are streaming in. Are you guys able to hear me? If you are able to hear me, can you guys type one in the chat box? Okay, great. Hi, Ray. Hi, Victor. Hi, Linton. Hi. So happy to see so many people actually today. Yeah, so we have more than 100 plus of people actually attending. Yeah, and we have Junior here also with me.
Hi, good morning, everyone.
Yeah. Okay, just a few more seconds. Okay, great. So let me start this properly. First of all, thank you very much, everyone, for joining today's webinar. It's holiday seasons. I know a lot of people are traveling. And for those people who already travel, I hope you have a good holiday. And for those who are actually traveling soon, I hope you are going to enjoy your holiday also. It's an end of the year, so we have very good years actually for this for markets, right? And of course, the last 2 months, the market has a bit, there's up and down, a bit of turbulence, but I hope you have a good investing years so far. And today we are very happy to have Yuan to join us for this webinar. And our webinar is co-organized by Share Investor and InvestingNote. So today our topic is about riding the REIT cycle, rate relief, market revival, the opportunities ahead. And this is the agenda for today. So Yuan will share about the REITs for about 40 minutes. And after that, I will actually talk about how to leverage share investor platform for investing in the REITs. And that will take about 10 minutes. Then after that, there will be a Q&A session. So for those of people who have a lot of questions, want to ask Yuan about the REITs, you can type in the chat box or so. So at the end, actually, we'll answer those questions as many as possible, for that. And Yuan has been a very good friend of me. In InvestingNote, he has been very popular members over there with a lot of followers. And when I start InvestingNote about 10 plus years ago, so where I start to meet a lot of people, fantastic people like Yuan. And he has been very strong supporters for InvestingNote. And he has been, fantastic supporter for a lot of people in the investing markets also, and very openly share a lot of things about he knows about the markets. And I'm very happy actually he's able to join us for this webinar today. So Yuan, the stage is yours. I will stop sharing now.
Okay. A very good morning to all of you, and thank you so much for your time to attend today's session. Time flies, and in the blink of an eye, we are into the final weeks of the year 2025, and I certainly hope that all of you have had an awesome year so far. Before I begin, I'd like to take a moment to thank the great team at Alpha Invest for organizing this event, as well as for inviting me to share my humble 2 cents worth about the REIT market today. My name is Yuan, and I'm the founder of the investment blog, the Singaporean Investor.sg. So a quick disclaimer here that everything that I'm about to share with you over the next 30 minutes or so, including any of the REITs that I'm going to talk about, are purely for educational purposes only. They are not meant as any buy or sell calls. And as always, you are strongly encouraged to do your own due diligence before you make any investment decisions. So for those of you who are hearing about me for the very first time, a very quick introduction about myself. I am a full-time retail trader in the Singapore, US, as well as in the Hong Kong markets, as well as a retail investor with my investments predominantly in the Singapore market, particularly on REITs, as my focus is on dividends, and REITs satisfy this criteria of mine. I'm also the founder of the investment blog, the Singaporean Investor.sg, where you will find posts related to analysis of the individual companies listed on the Singapore, US, as well as on the Hong Kong stock exchanges, reviews of results posted by selected companies in the Singapore market, as well as summaries of their annual reports as and when they are made available. I've also had the privilege of sharing my knowledge at the various investment education events, as well as on webinars organized by influencers. Finally, I'm also the author of the book, Building a Retirement Portfolio. As the name suggests, in this book, you will find the exact steps that I take to build my very own REIT portfolio. So for those of you who are interested in getting a digital copy of it, you can get it through my blog at the singaporeinvestor.sg. Or if you are interested in getting a physical copy, you can do so either in Books Kinokuniya or on Shopee, where it will be fulfilled by the book publisher. So what will I be sharing in today's presentation? For those of you who have been investing in REITs since the year 2020, I'm sure you will agree with me that the past couple of years have been a very bumpy ride, as many of the REITs have been hit by headwinds after headwinds. So, the first item on my agenda today will be to take a quick look at that. Next, I will be sharing some of the headwinds as well as tailwinds for the REIT sector in the year 2026 ahead. Particularly, I've identified 4 headwinds as well as tailwinds to share with you. Moving on, I know many are interested to know what I look at to help me decide whether or not a particular REIT makes it to my investment shortlist. So I'm going to spend some time to talk about that in today's presentation. I will also be sharing the spotlight on 4 REITs and business trusts listed on the Singapore Exchange, namely CapitaLand India Trust, Mapletree Industrial Trust, Mapletree Logistics Trust, and Fraser Centrepoint Trust, where I will be addressing some of your concerns about each REIT that some of you might have. Finally, I'll be rounding up the presentation by sharing with you an initiative I started in June and completed just last week, where I created a series of posts to look at each of the REIT and business trust distribution payouts, along with how their unit prices have moved over the past 5 years. Without further ado, let's begin. It has been a really tough 5 years for the Singapore REITs, where many of them saw their growth stop right in their tracks in the year 2020 when the COVID-19 pandemic broke out, and many countries around the world imposed lockdowns and movement restrictions to slow down the spread of the virus. Hospitality assets were the most badly hit because of the border shutdowns, followed by retail and office assets, and many of the REITs had to cut their distribution payouts because of a dive in their financial results. After the borders were eventually reopened and businesses slowly going back to normal in the year 2022, REITs were dealt with another blow. This time round, from an aggressive interest rate hike by the US Federal Reserve to a 23-year high, as inflation back then in the US was in double-digit percentages, and the series of interest rate hikes were meant to bring down inflation to more reasonable levels. As REITs relied on bank borrowings for expansion, be it for acquisitions or for asset enhancement works, these came to a complete standstill as the REITs management became prudent with investments to avoid over-leveraging. Not only that, a spike in interest expenses from the sky-high interest rates resulted in a slump in the distribution payout of many of the REITs, and as a result, the sell-off for the REITs continued. A glimmer of hope for the REITs came in September 2024 when the US Federal Reserve made its first interest rate cut by 0.5%, followed by another 2 interest rate cuts by 0.25% in November and December. That's also when we saw the unit prices of the REITs starting to recover. Of course, the recovery isn't even for all the REITs. Some recovered faster than others, especially those with a reputable sponsor, as well as those with a track record of stable financial performances, strong occupancy for its properties, and also a healthy debt profile. And as a result of a lower borrowing cost, we have seen some of the REITs management once again embarking on acquisition activities, as well as asset enhancement works for its existing properties to improve their income contribution. We have also seen in the recent quarters some of the REITs distribution starting to record year-on-year improvement once again, and this invoked investors' interest in the REITs further, especially given at about the same time the yields of the government bonds, namely the Singapore savings bonds, as well as the treasury bills, were declining as benchmark borrowing rates started to trend downwards. This is on top of the MAS rollout of the Equity Market Development Program, or EQDP for short, earlier this year, with an aim to strengthen the country's equity markets. And in my opinion, it also played a part in aiding the bullishness of many of the REITs' unit prices. Additionally, we have also seen 2 new REIT IPOs since 2021, where Digital Core REIT was listed on the Singapore Exchange. In July this year, the third pure-play data center REIT in NTT-DC REIT was listed, where its portfolio comprised of 6 data centers located in the United States, Australia, as well as in Singapore. And then in September, Centurion Accommodation REIT became the second REIT to be listed. The REIT is also the first pure-play workers and students accommodation REIT, with its portfolio comprising of 5 workers accommodation in Singapore, as well as 9 students accommodation, 8 in the UK and 1 in Australia. Looking ahead, there are also more REIT listings in the pipeline, including one by the property investment arm of Chinese e-commerce giant JD.com, as well as two other firms as reported in the news report in late August, along with UI Baostate REIT. This REIT is a spin-off from the Singapore-listed Baostate Singapore, with its portfolio comprising of 21 properties in Singapore and 2 in Japan. Assets-wise, they include logistics, industrial, and business space properties. All things considered, it certainly seems that the worst for the REITs have passed, and barring unforeseen circumstances, the REIT sector should continue to improve in the year 2026 ahead. Next, let us take a look at some of the possible headwinds as well as tailwinds for the REIT sector in the year 2026 ahead, starting off with the tailwinds. Current US Federal Reserve Chief Jerome Powell's term is going to end in May next year, with a new chief who is aligned with the current US President Donald Trump's view that benchmark borrowing rates should be cut more aggressively. The lower interest rate environment should bring about more acquisition activities for the REITs and their contributions to further improve on the financial performances and distribution payouts. This is on top of the REITs paying lesser in terms of interest expenses for its existing floating rate loans, along with a lower interest cost when they refinance their existing borrowings, all of which should see an improvement in the REITs distribution payout as a result. Next, the positive impacts brought about by the MAS EQDP program is likely to help the REITs unit price improve further due to an increase in the investors' interest. Also, new REIT listings is another one that can revive sector interest. And as I shared in the previous slide, there are already 2 in the pipeline, and we may likely see more coming up in the months ahead. Finally, improvements in things like the occupancy rate of the REITs properties, economies of countries where they are located could see valuations of the properties improving, and as a result, lead to an improvement in its net asset value. This may lead to a further improvement in the REITs unit price as they tend to rise in tandem to close the gap with its net asset value. On the other hand, REITs with overseas investments, particularly in several countries in the Asia-Pacific regions such as Hong Kong, China, South Korea, Japan, and Australia could see their income contribution continue to weaken because of the very strong Singapore dollar. Another headwind is related to the sluggish economies of some of the key markets of China, Europe, as well as the United States. This could result in the occupancy rates of some of the properties, especially those located in secondary markets. And as a result, income contribution by some of these properties in those areas may be negatively impacted. The next one is on lease expiries and on non-renewals relating to properties with older specifications, such as the traditional data centers that are unable to support the AI workload, or the older industrial and logistics properties with an outdated design or lack of modern features, making them less efficient for the current supply chain needs. REITs with such properties may face with headwinds in backfilling the vacant spaces. Finally, despite benchmark borrowing rates being cut by close to 2% by the US Federal Reserve between September last year until now, they are still at a very much higher level compared to during the pandemic, where benchmark borrowing rates back then are at the range of between 0 to 0.25%. Hence, in terms of borrowing costs, they are nowhere near the days of the pandemic, and this could pack back the growth of the REITs distribution payout to some extent. Next, let us move on to the next topic, which is my criteria for selection of the REITs. There are a few things I look at, ranging from its financial performance to its portfolio occupancy and debt profile over the period of 3 to 5 years. Let us have a look at what they are. First, on its financial performance, there are 2 things that I look at: its gross revenue and net property income, where they have to be stably growing. On portfolio occupancy, my focus is on a few things. First, the occupancy rate have to be maintained at above 90%, with a well spread out tenant lease renewal and no one single tenant contributing a huge percentage towards the REIT's gross revenue. And as far as the debt profile goes, I would like its gearing ratio or aggregate leverage to be maintained at around 40% or below. And as far as its interest coverage is concerned, my preference is towards those that are able to maintain it at between 2.5 times and 3 times. Previously, my requirement was around 5 times, but I have since shifted this down a bit on the account that interest rates is unlikely to be at hyper low levels anytime in the near or even in the midterm. Still on its debt profile, I prefer REITs with a well spread out debt expiry, as well as those with a relatively high level of borrowings hedged at fixed rates at around 70%, so they will not be so adversely impacted by any potential negative interest rate swings. Next, on distribution payouts, my preference is towards those with a growing one. And finally, on sponsors, I would prefer to invest in REITs with a more reputable sponsor for two reasons. The first is that such sponsors can provide REITs with a steady pipeline of assets to which they have the right of refusal to acquire. And second, in terms of borrowing costs for the REITs, it tends to be lower because of the sponsor's reputation. Next, I want to address some of the concerns that investors have on four REITs and business trusts listed on the Singapore Exchange, namely CapitaLand India Trust, Mapletree Industrial Trust, Mapletree Logistics Trust, and Fraser Centrepoint Trust. Once again, do take note that whatever that I'm about to share with you in the next couple of slides do not serve as any buy or sell calls for them. So India is currently the fifth largest economy in the world. And according to a report on The Economist published last month, they are expected to overtake Japan to become the world's fourth largest economy by the end of March 2026. As retail investors here in Singapore, one of the best ways for us to invest in the growing economy in the country is through the Singapore-listed CapitaLand India Trust, or CLINT for short, where it focuses its investments on high growth sectors like IT and new economy assets such as data centers. As at the end of the latest financial year on 31st December 2024, the business trust portfolio comprises of 10 IT business parks, 3 industrial facilities, 1 logistics park, and 4 data centers in key Indian cities of Bangalore, where it has 2 properties, Chennai, where it has 5 properties, Hyderabad, where it has 4 properties, Mumbai, where it has 4 properties, and Pune, where it has 3 properties. One of the things I like about Clint is the stable growth in its total property income as well as in its net property income over the past 5 years, where it has recorded year-on-year improvements every single year during this period. In terms of its compound annual growth rate, or CAGR for short, it is at 7.7% and 6.8% respectively. On distribution payouts, the business trust has a half-yearly distribution payout frequency, and over the last 5 years, its distribution payout have declined in 2 years. First, in the financial year 2021, and that was due to an enlarged unit base and that was due to a one-off reversal of a dividend distribution tax provision, and another in the financial year 2023 due to an enlarged unit base following a preferential offering exercise being done, along with a weaker Indian rupee against the strong Singapore dollar. And speaking of currency headwinds, the management is well aware of investors' concern of the weak Indian rupee against the strong Singapore dollar. And the ex-CEO of the business trust, Mr. Sanjeev Dasgupta, have addressed this in one of the presentations conducted by SIAS, which I attended quite some time back, where they aim to improve the business trust distribution payout by having a faster growth in its financial performance to which they have a control over that can outpace the weakness of the Indian rupee to which they have no control over. Another concern that investors have in Clint is its high financing costs, where the range of between 5.2% and 6% over the past 5 years is higher than the average all-in borrowing cost of between 2.5% to about 4% for the other REITs listed on the Singapore Exchange. This can be attributed to the high benchmark borrowing costs in India, and as you can see from the line chart above, it has ranged from around 4% to 6.5% between the years 2020 and 2025, and Clint's average cost of debt is somewhere around this region as well. Another thing to note is that as the business trust borrows in the same currency as it receives its rental income from its tenants, there's sort of like a natural hedge there. Next, we have Mapletree Industrial Trust, or MIT for short. The REIT invests in industrial properties such as high-tech buildings, business park buildings, flatter factories, stack-up and ramp-up buildings, as well as light industrial buildings, together with data centers. As at the end of the latest financial year ended 31st March 2025, it has 56 properties in North America, 83 in Singapore, and 2 in Japan. And as far as diversification of asset types goes, it is rather well divided, with about 50% of its portfolio comprising of data centers, and the other half comprising of industrial properties. In numerical terms, 64 properties in its portfolio are data center assets, with the remaining 77 being industrial assets. Looking at its financial performance, MIT's gross revenue and net property income have also saw year-on-year growth over the past 5 years, with its gross revenue growing at a CAGR of about 9.7% and its net property income at about 8.7%. Next, on its distribution payout to unit holders. MIT is one of the few REITs in Singapore that have continued with its quarterly distribution payout frequency after the MAS removed the requirement for listed companies to report their full financial results on a quarterly basis from the year 2020, and it is something that is much appreciated by many income investors. In terms of the growth of its distribution payout over the last 5 years, it has saw slight dips in the financial years 2022-23 as well as in the financial year 2023-24 because of an enlarged unit base with additional units issued under the distribution reinvestment plan to fund the growth initiatives, including the redevelopment of Mapletree High-Tech Park at Kallang Way. Despite that, over the past 5 years, MIT's distribution payout still managed to record a stable CAGR of about 1.6%. As far as MIT's portfolio occupancy over the past 5 years goes, I'm sure you will agree with me that it is maintained at a very high level of above 90%. However, one slight headwind the REIT is faced with in recent quarters is the declining occupancy of its data centers in North America, which have saw a steady decline every single quarter since the second quarter of the financial year 2024-25, from about 90.9% then to a low of about 87.8% in the second quarter of the financial year 2025-26. On this, from my understanding from the REIT's investors relations, most of the non-renewals were from its enterprise and end-user facilities, which the REIT acquired in the year 2017, where the weighted average lease expiry then was about 6 years. These data centers are located in secondary markets and are not designed for AI computing workloads, making them harder to release in the current environment where the demand is stronger for higher powered AI capable data centers. Despite of that, the IR shared with me that the REIT have managed to secure leases of about 184,000 square feet, of which 23% of these spaces are leased out to new tenants. However, most of these new leases will only be starting in the next financial year. Additionally, as some of the leases include rent-free periods, which is very common for US leases. Hence, in terms of revenue recovery, they may lack occupancy recovery. And as a result, as far as distribution payout goes, they may continue to remain challenged until the end of the next financial year. The IR also shared with me that the management is currently actively looking at acquisition opportunities for data centers in the European cities of London, Amsterdam, and Dublin, along with Asian cities of Japan and South Korea to reduce its reliance on North America. The next REIT in focus is another Mapletree REIT in Mapletree Logistics Trust, or MLT for short, where it focuses on investing in logistics property in the Asia-Pacific region. And as you can see from the right-hand side of this slide, where I list down the number of logistics properties the REIT has in each country, I'm sure you will agree with me that it is very well diversified. The same can also be said for its gross revenue contribution, where no one single country contributed a huge bulk towards the REIT's gross revenue. And in the latest financial year ended 31st March 2025, the 47 properties in Singapore contributes the most towards MLT's gross revenue at around 28%, with the remaining 8 countries contributing between 1.1% and 17%. Now, let us take a look at the financial performance of MLT in the last 5 years. And as you can see from the growth of its gross revenue and net property income in percentage terms, no doubt it has managed to record positive growth over the last 4 years, but its growth rate has slowed. And in the latest financial year under review, it has recorded a year-on-year decline. The chief culprit of this has been the weakening currencies in the various Asian countries against the very strong Singapore dollar. Unfortunately, this is something that the management has very little control over, in my opinion, and one of the catalysts for the REIT will be the loosening of the monetary policy of the Singapore dollar by the MAS. However, this is provided that currencies of other Asian countries do not weaken further when the time comes. Regardless, over the past 5 years, the REIT's gross revenue and net property income still managed to grow at a CAGR of 5.3% and 4.6% respectively. Next, on the frequency of MLT's distribution payouts. Just like Mapletree Industrial Trust, the management declares a distribution payout to the unit holders once every quarter. However, as far as the growth of its distribution payout over the past 5 years go, they have weakened in the most recent 2 years. In the financial year 2023-24, it was due to a higher borrowing cost and a larger unit base, while in the financial year 2024-25, it was due to a combination of lower net property income, higher borrowing costs, as well as a larger unit base. MLT's portfolio occupancy has remained at a high level of above 95% over the past 5 years. While the occupancy rate of its China properties are slightly below the REIT's overall portfolio occupancy rate, it is still above 90% over the quarters, which I consider to be very strong. The only concern here is with the rental reversion. Since the REIT has started to provide a breakdown of the numbers for each geographical location from the third quarter of the financial year 2023-24 onwards, you can see that it has slowly deteriorated from a negative 10% then to a high of negative 12.2% in the second quarter of the financial year 2024-25. However, the trend has reversed from the following quarter, where it has improved gradually, even though it is still in negative percentages. I will continue to take a close look at the rental reversion for new and renewed leases for its properties in China in the coming quarters to see if this trend continues to improve. But as things stand, in my personal opinion, the worst seems to be over as well for its properties in China. Now, let us take a look at the fourth and final REIT in my case study in today's presentation, and that REIT is Fraser Centrepoint Trust, or FCT for short. The REIT has an investment focus on retail assets in the various heartland locations in Singapore. As at the end of the latest financial year on 30th September 2025, its portfolio comprises of 9 retail properties and 1 office property, which is Central Plaza in Tiong Bahru. In case you are wondering, the property was added to the REIT's portfolio when they acquired Asia Retail Fund Limited back in October 2020, where its portfolio comprised of a couple of retail malls and this particular office property. The REIT is also one of the few that derive all of its income from the home country. Hence, it does not face with any forex risk. However, in terms of opportunities, it is limited as Singapore is only this big, and there aren't many retail properties in this country that is not currently owned by any of the REITs. In this slide, you will find the REIT's financial performance as well as its distribution payout to unit holders over the past 5 years. First, on its financial performance, the slight decline in the previous financial year was due to the absence of income from Changi City Point, which was divested in October 2023, along with a lower contribution from Tampines 1, which was undergoing asset enhancement works back then. Works has since been completed in August 2024, and it's now Hougang Mall's turn to undergo asset enhancement works, where works is expected to be completed next September. Apart from that, the remaining 4 years saw the REIT's gross revenue and net property income recording a stable growth and recording a CAGR of 2.7% and 2.4% respectively over the past 5 years. Now, on its distribution payout to unit holders, it saw slight declines in the financial years 2022-23 as well as in the financial year 2023-24. In the financial year 2022-23, it was due to a surge in finance costs, while in the financial year 2023-24, it was due to lower net property income as well as an enlarged unit base. As far as the REIT's portfolio occupancy goes, I must say FCT have one of the strongest numbers among all the REITs listed on the Singapore Exchange, where its occupancy rate is maintained at a high of at least 97%. The same can also be said for its rental reversion, where apart from the financial year 2020-2021, where the negative rental reversion was due to the COVID-19 pandemic, the remaining years thereafter saw its rental reversion not only return to positive percentages, but also recording gradual improvements every single financial year. The only thing which investors are probably worried about is whether the footfall to FCT's malls will be impacted once the JB Singapore Rapid Transit System, or RTS for short, becomes operational in December 2026, which is about a year from now. In my personal opinion, this is not too much of a concern for a couple of reasons. First, the tenants in FCT's malls are in essential businesses such as F&B, supermarket, medical including clinics and pharmacies, lifestyle services such as hair and nail salons, arcade centers, as well as enrichment classes, things like tuition centers, language classes, and music schools. Especially for things like clinics and enrichment classes, I really do not foresee Singaporeans traveling to JB to seek medical help when they are unwell, especially if it is for things like a common cold, or going across the causeway for things like tuition centers, where the syllabus is different, or for things like language classes, whereas it is way too troublesome to do so, at least in my personal opinion here. Next, the URA's plans for Woodlands Regional Centre, where, once completed, will boost the organic footfall to the precinct, and FCT's Causeway Point will benefit from this. And finally, the RTS will also help to bring about an increase in the inflow of Johorians coming into Singapore, whether is it for work or for leisure, which will bring about higher human traffic at Causeway Point. I would like to think that the footfall is going to be something like Jurong Point in the west, where the mall is a popular destination for Malaysians to stop over for some drinks or even a meal before returning to Malaysia via the Tuas checkpoint. Now, for the last item in my presentation today, which is an analysis of the REITs distribution payout as well as their unit price movements over the last 5 years. Some of you may not be aware, but I started an initiative back in June this year where I shared about each of the REITs distribution payouts, as well as their unit price movements over the past 5 years. I've posted them on the Singapore Investors Instagram page, as well as on InvestSG, which is a relatively new investment platform focused on the Singapore market that is created and managed by Alpha Invest and supported by SGX. It is free for all to join and participate. The reason why I started this series was because I noticed that some investors invest in REITs purely because of their high distribution yields alone, without realizing the fact that those with high yields, about 10% or more, often have their distribution payout in dollar terms on a downward decline over the years. Another thing is because I often get questions relating to yields at the different price points. Hence, I decided to address both concerns in this post series, which I just completed my analysis for the REITs and business trusts listed on the Singapore Exchange at the end of last week. So for those of you who are interested, you can check them out on either on the Singaporean Investors Instagram page at the Singaporean Investor, or on my profile page at InvestSG at investsg.asia/users/LJunyuan, which is LJUNYUAN. With that, I've come to the end of my presentation today. I sincerely hope that you have found the contents I presented over the past half an hour or so useful. So for those of you who have yet to connect with me and would like to do so, you can find me on Instagram and Telegram at the Singaporean Investor, or on InvestingNote at LJunyuan. If you have any questions for me, even after today's event, you can just drop me a message through the contact form on my blog at thesingaporeaninvestor.sg, or you can send me a private message on Instagram, Telegram, or on InvestingNote. Finally, if you'd like to grab a copy of today's presentation slides, you can scan the QR code to do so, or visit the singaporeaninvestor.sg/DEC2025PPT. If you are unable to download now, you may want to try again in another hour or two. So with that, I would like to thank you once again for your time. And now I shall pass the mic back to Shanison.
Thank you, Junyuan, for the great sharings. Just now I saw one participant's comment say, "Can you speak a bit slowly?" I think Junyuan is very excited, about sharing for today. So but don't worry, Junyuan is kind enough to say that he can share the slide with you guys. And then after the webinar, we will actually be able to send a post webinar email to you guys as well. And Junyuan said that we can actually send over the presentation deck for you guys, for this. So don't worry about that. So now I just want to quickly jump into my session. So, but before I start, let me probably introduce myself. For those people who know me, I'm Shanison, and you know me probably as a founder of InvestingNote. I've been running InvestingNote for quite a long time, and you know that actually InvestingNote has a merger with Share Investor, about 2 to 3 years ago. So right now, InvestingNote and Share Investor is under the Alpha Invest Group. And then under the whole group, we also have another platform which Jin shared just now called InvestSG.Asia. So it's a dedicated community platforms for Singapore markets informations. And it's actually powered by, it's actually supported by IGS, for this to build a community just focus on Singapore markets, for that. For today, I want to share quickly about, how you can use share investor platforms to invest in the REITs markets quickly. So just now, Chin shared, he used some of those, metrics actually to evaluate some of those REITs, whether it's worth investing or not. And for those people who don't know about share investor platform, it's a very comprehensive information platforms, for you to invest in the markets. So any kind of information you're looking for, no matter it's fundamental data or technical analysis tool that you're looking for, can be found under this share investor platform. So one of the key things I want to share today, because we're talking about REITs, right? So let me jump into something called REITs metrics. So you are able to see all the REITs in Singapore, right? So these are about 40 plus REITs in Singapore over here. But this REITs metrics basically, it shows some of those key REITs metrics and ratios that you should be looking for. Things that just now, Jean also shared about the distribution yields, right? So other metrics like the gearing, interest cover ratio, cost of debt, so these are ratios, occupancy rate, which one he has highlighted quite a few as well for this. It's all listed over this in one single platforms. And then you can compare across all the REITs together. And another way is you can also sort based on the occupancy rates, to see that which REITs has a higher occupancy rate over here. And this is actually very good ways for you to evaluate in terms of different REITs. And just now, Jin also share, that what about the historical data, for the REITs, which is actually very important. I think just now one of the examples he shared is Frasers, right? So let me just go back to Frasers. Okay. Frasers Centrepoint Trust. Okay. So if you go to Frasers Centrepoint Trust, we have a lot of information about the companies, right? Overviews. So you have charts, you have a financial analysis. So this is something called the smiley faces that we invented to tell you that, quickly that, based on some of those key ratios in the company, how is it performing, So this distribution payout, okay? So it has been increasing over the past 60 months. So it's a bit, smiley face. Some of those other ratios might not be so good. Then you can see other kind of smiley faces over here. But how is this being defined? It's all described over here, like profit growth, revenue growth. Revenue has been up and down in the past years. Net earnings margin. So you can explore more in terms of these smiley faces. And just now, Jin shared about some of those financials, right? So we can see these are all the financial results we have over the past few years, up to more than 20 years of data. Now, of course, depends on the company, how many years of historical data they have, for that. And if you go to REITs metrics here under the financials, you are able to see the historical key metrics ratios for a company, like occupancy rates for this Frasers Centrepoint. It has been quite, impressive actually, 90 close, almost to 100%, in past few years. Rental reversion rate, you can also compare across, past few years as well. And gearing ratios, cost of debt versus the fixed debt as well, for that. And then we also tabulate data to show you clearly these few ratios, what are the data over there as well. And then just now you share about the distributions, right? So you can also see that, this is a dividend analysis. So we can see over here as well, these are distribution per unit, the green color one. So you can check across the different years. Is it increasing or decreasing, and against the earnings per unit as well, So basically, based on this, you are able to have a clear picture in terms of how the company or the REITs is actually performing. And of course, actually, apart from this, we have a lot of quite others features as well. Like for example, portfolio. So I know that a lot of people actually use multiple brokers, to track your portfolios, right? But this portfolios, basically you can consolidate all your holdings into one single portfolio, and then we automatically track in terms of performance, even including things like dividends as well, how much dividends you're collecting. So it's automatically actually populated to show you that the return for your investments, capital gain, and also the dividends yields as well, for that. Okay, so just a very quick sharing on this, but for this Christmas season, we have the biggest promotions. So this is advertisement time. Just bear with me for a very short one. Christmas seasons for this, we have a promotion. It's ending end of this month. So for the first 15 days, actually, we have this 15% off plus 1 month extra. But since yesterday, we have starting this second bundle, which is 15% off plus 8% additional discount. So it's a huge discount actually in terms of what you get in a normal subscription period for that. It's actually ending in 2 weeks time for that. And apart from that, we are also giving out lucky draw prizes, fair price voucher, gold, gold bar, iPhone, this year the gold price has been going up quite a lot, right? So a lot of people like gold bars, for this. So there's also a cruise as well. So this is once in a year's opportunity, for this. So do check out our Christmas promotion. And apart from that, there's a special one that you were giving out as well. Just let me share the screen quickly. So as you are aware, Juan is also a book author. So he wrote this book, Building Your Retirement Portfolio. So for those participants today, attendees for this webinar, if you subscribe for our Share Investors Pro or Premiums today and after the webinar, you can actually scan this QR code and then to fill out your details. And we are giving out the Juan's book, and we deliver to your house as well, for that. And we will actually email you the link to this Google form. So you don't have to hurry to scan this QR code. So no worries about that. And this is especially exclusively for those people who are attending this webinar. So grab this chance, for these promotions. This is end of my advertisements. So I will actually hand over back to Juan for the Q&A sessions, for that. Juan, there's some questions actually in the chat box. Are you able to see it?
Yeah, I'm able to see the question. Very interesting ones indeed. Yeah.
Yeah, so maybe actually, Juan, you can start sharing some of those. I think one of the key questions I think some people are asking is, what are the reasons you choose the 4 REITs to share? Are you most bullish on the 4 REITs on the S-REITs universe? I think it's asked by CJ and, I'm not sure you want to answer this
Very
question.
interesting question there. So I thank CJ for the question. So the reason why I chose these 4 REITs is because when I was browsing through the various investment platforms, I noticed that people have concerns over these 4 REITs lah. So basically, I just want to clear some of these concerns that people have regarding this, especially like take MIT for instance. I know that many of investors are a bit concerned about the headwinds related to the North American portfolio. And also I've spoken to the IR to find out more about this lah. So I feel that this is a concern that many want to know. And why Fraser Centrepoint Trust? Because I think it's a very good read. And then I noticed that many have the concern and the worry that FCT's this financial performance will actually come down because of this RTS. But I think there are many reasons why we should be optimistic instead of being pessimistic. Yeah, and also for CapitaLand India Trust, because as we know that India is a very fast-moving economy. Even in the news today, I read that Japan, right? A lot of companies in Japan wants to invest in India because it is very fast-growing. And as we all know that because we are not a citizen in the country, we can't invest in the NSE, which is the Indian Stock Exchange. So I think the best way that we can do so is through a business trust like a CapitaLand India Trust. And what's more, is traded in SGD. So for MLT, I know that many have concerns about the properties in China. So I just wanted to share some statistics. So I really hope that I managed to shed some light lah. And it's not just all doom and gloom for MLT. Yeah, hence these 4 REITs. I can share more, but I think because the time is quite limited, if I were to talk there, I think it will need a few hours to do so. Yeah, so in the interest of time, I decided to just zoom in on these 4 REITs. Yeah.
Yeah, thanks, Juan. I think it's also these few REITs actually are, I think, more probably well known also. So
Yes.
it can actually ring a bell for some, maybe there are some attendees here who are new to REITs as well, but at least you've been to some of those shopping malls, right? Like Business Center Points. So it can ring a
Yeah.
bell. Yeah. Okay, I think there's some other questions, Junior, over there.
Mhm.
Do you want to pick some of those, or you want me to pick some of those?
No problem. You can pick them.
Okay, I think for one question is about how about the weakening of the rupiah, for the Capital India Trust.
Indian rupee against the capital India trust. I think the weakness of the Indian rupee, as I've shared during my presentation just now, I think it is something that nobody has control over because we can't influence the central bank. Even the management cannot do anything about it. And the management is well aware of this. So what they can do, right, what's within their control is in terms of the financial performance. And the management, what they are doing is that they are trying to achieve the growth rate, right, that is faster than the depreciation of the Indian rupee. And as we have seen in the recent quarters, right, they have done so. They have done so, lah. So as you can see that the clean's distribution payout has been improving in the recent quarters.
Mm,
Yeah.
okay. Gian has another question, it's actually from Kenny. He's asking that how to identify reputable sponsors in REITs.
Wow, that is a very, very interesting question there on reputable sponsors. I think for listed companies, what we can see is through like the financial performances of the sponsors lah, and how in terms of financial performance, how they have performed over the years for the listed ones. Like, I mean, for the non-listed ones, I think what we can see, right, is through the financial performance of the REITs, whether or not, in terms of the REITs, right, are they doing acquisitions to try to grow the REITs? Or if not, try to do asset enhancement initiative. This is also another way to try to improve the contributions of the existing properties also, which can help grow the REIT, even though it is slower in terms of the revenue growth compared to acquisitions lah. So I think we can have a look at things like that. And also in terms of the growth of the so-called occupancy rate and also the health of the debt profile. And also more importantly, distribution payout. I think we are all
Mm,
investing in this for distribution payout. So it must be stably growing.
mm,
Yeah.
okay. There's some more questions from Ganshi. He said that he's a shareholder of Capital REITs and passed by the latest acquisition and wondering whether the shareholders should subscribe for the right issuance, for that. But this one is not recommendation. So we are doing webinar. There's a live stream as well. So if you feel sensitive, Junior, you can, share whether you want to share this.
I think it's okay. No problem. I can
Yeah.
share my humble 2 cents worth on this lah. So I think one of the things as a shareholder of Capital REIT, I think you may want to ask the management some questions. Number one is why they want to proceed with this acquisition, despite the fact that it is actually DPU dilutive. Okay, from my personal experience as a REIT investor since late 2019, I think this is the first time I actually saw an acquisition announcement that is actually DPU dilutive. And there's also a lot of discussions on platforms like on InvestingNote or as well as like on IG. People are talking about it. So I think one of the things that you can do as a shareholder is to actually ask the management why they decide to proceed with the acquisition despite the fact that it is being yield dilutive. And also, let's say if this property, right, is going to be so-called yield accretive in the future, is there any projections when this particular property will become yield accretive, DPU accretive, so-called? And also like as a shareholder, I think I mean is personally my personal take is that you have a right to actually ask the management these questions. And then from there, you can have a feel based on the replies from the management. Yeah. And also, one thing you can ask is what is their plans to move the REIT ahead? Because considering, I think a couple of months back, if I remember correctly, they have also went into the acquisition of a retail mall. So what
Mm.
is their plans moving ahead on that? Of course, again, this is my own personal take. I'm not an
Mm.
investor of capital REITs. And just looking at all the news flow that's coming in, I've studied through some of these presentation slides and reports, and this is the questions that
Mm.
I have. So maybe as an investor, you may want to seek some clarification from the management. I think they will be in the best position to answer this.
Yeah. Gee, so since you mentioned that you're not a shareholder of capital REITs, I think there's one question asking you whether you are shareholder of the few REITs that you mentioned, you know.
Oh, which one? Which REITs?
No, the few REITs that you share as an
Oh,
example. So they
Oh
say,
yes, I'm a
are you a
investor of
shareholder,
these
you know,
few
for
REITs lah.
that?
So every single quarter when they release their business updates and annual reports, I will analyze them and share in a separate post on my blog. And if there's any concerns that I have, I will not hesitate to ring the management up, to send
Yeah,
them an email to seek some clarifications about it. And I will share my findings in separate posts, just like what I did in the latest earnings seasons where I shared about some of the concerns facing MIT in a separate post after my discussions with the IR and also on
yeah,
UOB. That's banks also. I am not sure. Yeah, that's something for another day.
yeah. One thing I was quite impressed with Jian is Jian was sharing one day he was actually publishing a post about a REIT. I think Ben don't mention anything. Then he raised some questions over there. Then the REITs, the company actually arranged a session for him to talk to the CEOs directly to address some of those. So that's how he can actually get the inside information, not inside news, but get the details information about the company. And he's actually very genuine in terms of sharing, in terms of what he find out, you know. And I know that he will hold back if he has questions about any of these companies also.
I try my
Yeah,
best. So I think
yeah,
investors like ourselves, I think we deserve to know because we put in our hard-earned money into these companies. So naturally, I think we must be aware of how these companies are being run lah.
yeah.
Yeah.
So Jing, got one more interesting question. I think from Henry. He said going into 2026, are REITs with domestic assets more favorable than the REITs with substantial foreign assets? What's your
Oh,
view?
very interesting question. Okay, I think each have their pros and cons. And right now, because of the very strong Singapore dollar, right, many investors choose to put their money into pure play Singapore REITs or those that derive a huge percentage of their revenue from Singapore. And as you can see, right, from how the unit prices of some of these REITs have moved, things like Fraser Centrepoint Trust, CapitaLand Integrated Commercial Trust, or even AIMS APAC REIT, their prices have remained stable over the most recent 1 or 2 years or even longer, while the unit prices of many of the REITs, especially those that derive a huge percentage of their income overseas, right, they saw their unit prices drop because of weaker contributions as a result of a weaker foreign currency against a very strong Singapore dollar. So, of course, everything have their pros and cons. Let's say if you were to invest in pure play Singapore REITs, no doubt there is no risk related to foreign currencies. But then, as I shared just now, Singapore is only this big. And in terms of acquisition opportunities, it is few and far between. And as a result, right, in terms of the growth in the coming years ahead, it is likely to be just stable, coming in from an increase in rents from the tenants as well as from asset enhancement works. And on the of course, on the other hand, if you were to do acquisitions, one of the things is that the growth is unlimited. You have very unlimited opportunities for growth because some of the countries they have a lot of spaces for the REITs to actually expand and grow into it. But on the other hand, for weaker currencies, right, it's something that I think none have control over lah. But despite of that, I think if we were to just stay in Singapore, there's also a risk also. So I think one of the good things is to actually be well diversified. Something I think MLT has done very well as I've shared in the earlier slides, right? They are very well diversified in many countries. And also it's like there's no one single country, right, that really contributes a lion's share towards the REIT's overall gross revenue. But of course, then you have another risk lah. So I think as investors, we should be well diversified as well, not just in terms of REITs, but also in terms of the current, in terms of the geographical diversification. So I think it's good to have a mix of those that invest pure only in Singapore as well as those overseas.
Mm. Okay, Jin, thanks for sharing that. There's one question from Victor. I think it's more bit more educational. What are the legal responsibilities of the sponsor? For example, Manulife REIT, the sponsor is so strong, but did the sponsor done anything to help up legally?
Well, that one is a very interesting one. So I think one of the things I mean as a investor, I can't comment about Manulife US REIT and what they have done now lah. But personally I feel that again as investors, if you have such concern, right, I would strongly encourage you to actually speak with the IR directly and seek some clarifications on this. And through how they reply, right, and you actually can have a sense of whether or not the management is really transparent and forthcoming with some of these challenges. I think not just that, but also what they are going to do, right, to navigate through the headwinds. And from that, right, I think as investors, then you can have a better idea, right, on what you want to do with your investments moving forward. So I always encourage people, right, whenever they have a question, always just email the IR to seek clarification. And from there, how the IR respond, you can really tell because if the IR is very transparent and very forthcoming with the challenges as well as what they are going to do, right, this is one of the hallmarks of a very good REITs management. And also it's one of those things I look out for whether or not when I make any divestment decisions or just hold on to the REITs and wait for its recovery. Yeah, another thing is also through AGMs because you can also look at the person's, the management's non-verbal expressions. That also tells a lot. So I really encourage that lah. And as for Manulife US REIT, I think it's hard for me to answer at this point in time because I think they just passed an EGM to seek the approval to actually sell more properties to actually raise funds. But I think they have no choice also, to be honest, because if they don't raise funds, then if they don't approve, then the REIT is headed towards liquidation and investors will get back nothing.
Mm.
So, but again, this is my humble 2 cents worth about this lah.
Yeah.
And my advice is always for as an investor, to always connect with the management, connect with the IR to seek more
Mm.
clarifications on this. And it's
Yeah.
your right to do so.
Mm. Jody, I think someone asking what is IR. So maybe I just address this. This is an investor relation. So for the listed companies, right, they need to have this investor relation team in the company to basically, to address any kind of questions that investors, like shareholders, have, for that. So you can actually reach out to them. They should have dedicated the team and emails actually over there. And actually, personally, I attend quite a few so-called private sessions arranged by those listed companies, especially by REITs for that. I would say that in the past few years, they become very, very open to engage with a lot of investors, and they are doing a more and more active, actually, honestly. So, which is a good job actually have done by those listed company in Singapore side. So, if you have any kind of questions, you can feel free to reach out to them by a few areas that Jean has shared. How you can reach out to them. And of course, the other way is you can post out those questions, discussion at InvestingNote, and then you can actually have more clear picture in terms of some of those ideas. Learn from each other is something actually I feel that is actually very useful, especially when it comes to investing and trading, because the way that you're looking at something might be a bit narrow, but somebody else views might suddenly strike to you that, oh, well, actually it's true, that area I never think about this. I mean, due to actually the interest of time, I think we can maybe pick one or two more questions only, Jin Yan. Because just now Jin actually shared with me that he emphasized that twice to me, say that we should not overrun, because we already commit to them. It's 1 hour, for that, But I know that you guys have a lot of questions, so maybe I just pick two more questions. How is it, Jin? Yeah, I think we are reaching
And no
12:30 already. Okay,
no problem.
so one question I think is actually interesting is, how come SG REITs not doing very well in the past where STI is already all-time high? So we see all these people every day, STI all-time high, all-time high. So this is the questions maybe you want to share a bit on the views.
SG REITs is not doing quite well. Yeah, in the past, it's not doing quite well, as I shared in the early on in my presentation. Since 2020, they have been hit by COVID, number one. So after COVID recovered, the next thing is but because of the high interest rates environment. And as a result of that, right, a lot of them have been shifting their funds out of REITs and into things like the safe haven, such as Singapore savings bonds, as well as the treasury bills. Then only recently, right, when the US Federal Reserve starts cutting interest rates, then REITs start to see some investors' interest coming back again, because at the same time, the yields of the safe government bonds have been falling. So I think I've explained that in my earlier presentation. So I think moving on, I think we should see REITs continuing to benefit with interest rates coming down even more. And as far as STI is concerned, right, you need to know that for the STI, right, the heaviest weightage for the STI comprises of the three banks, DBS, UOB, and OCBC. And together, if I'm not wrong, right, collectively, they have a weightage of about 50%. So if the banks go up, the STI will also go up. So I think you have seen DBS have been, hitting new highs because of the very good financial performances. OCBC is also doing very, very well in that regard. And this helped to push the STI to all-time highs. And of course, on the other hand, if banks start to come, I mean the performance of the banks start to weaken, then you will probably see the STI coming down. Yeah.
Okay, great. So I think maybe just one more last questions. I saw quite a few guys talking about NTT. So he's saying that why NTT is dropping below the IPO price. Is there any views you have? And another attendees is saying Yash. I think he's saying that since NTT is dropping, is it worth? I don't say buy, but worth looking at it. That kind of. What's your view? For this?
Okay, as far as NTT is concerned, for me personally, I don't look at REITs that is just newly listed for a couple of reasons. Because I think in terms of prospectors, right, sometimes some of these companies can be very optimistic on the growth pre-IPO, but after IPO, things might be different. So for me personally, if I want to invest in a company, I would want to wait for it to have 3 years worth of post-IPO financial results prior to looking at it. So you know how it actually perform, right, are following the listing. And as for why the price is dropping, I think the unit price can move for a variety of reasons. Some because of speculation, some because, of people think that the other pure play data center REITs are a better buy. So there are a variety of reasons. I think it's difficult to pinpoint to actually why exactly, right, price of a particular company is falling. Yeah, but I think we as investors, we should always focus on fundamentals, always focus on the statistics, and let the statistics tell you whether or not you should invest or not. And of course, when it comes to investment, everyone is different for different reasons, because everyone, right, when it comes to building their own portfolio, they have different goals. Some they want it to be dividends purely because they are retirees and they want the portfolio to give them a regular stream of income. Some they prefer growth companies because they want to enjoy the capital appreciation, or some they will have a mix of both. And the percentages of between growth and dividends, it really varies depending on what you want out of your portfolio building efforts.
Yeah. Okay. Thank you, Jin. I think we have come to the end of the webinar. So in fact, we exceeded by about 5 minutes actually. So I think there are still some questions actually inside we didn't address. But what you can do is actually you can go to investingnote.com. So I actually send a link actually into the chat box. So you can go to his profile and actually you can post some of those questions over there. And I believe actually we should be happy actually to share with you some of his views. But again, disclaimer, this is personal views. So there's no buy and sell calls for this. So just use your own judgments to decide actually what kind of investments actually you should do it. And try to use shareinvestor.com as well. So this is a platform actually we basically someone is asking me what is subscriptions about. So basically this is such a very comprehensive information platform for you to analyze the companies, to look at the details, data about companies before you make any kind of decisions. For those people who are also asking about where's the Google form to claim the Genius book after the subscription. I already posted in the chat, but don't worry, we will actually email the details actually to you. And there's some people asking about the slides, for Genius as well, because there's some people who came a bit late. So don't worry also, we will actually email the slides, for you. Genius is kind enough actually to share. Let me you know that some of those speakers, some people actually they might not want to share the slides, because they feel that it's actually very private, belongs to them. But Genius is actually very kind to say that he's very happy to share the slides. And in fact, actually, he initiated this conversation with me just now for that. So with this, that's the end of our webinar today. I would like to thank Yuan for joining us, taking this December's, I know busy period because there's a big things for him coming up. I don't want to share more. Let him share the things with you guys. So it's actually very busy. So thank you, Yuan, for taking your time to join us today. And I would like to thank especially for all of you guys who joined in today. I know it's actually Christmas, New Year season, holidays, and some of you might be traveling and attending it today as well. So we are really, really thankful for you guys for joining us today for this webinar. So have a good holiday seasons ahead. I wish you guys Merry Christmas and a New Year's ahead first. So thank you very much, guys. Thank you.
Thank you very much, everybody, for your time. And very Merry Christmas to you and your family. And a very hot 2026 ahead.
Hoya.
What?
Thank you, guys. Thank you.
Thank you.